Hello, everyone. In this lecture, we are going to be going over some profitability ratios for Intel. And we will be looking at the gross profit margin, net profit margin, and operating margin. So for ratio analysis, there are several ratios that management, investors, stakeholders, and employees use to measure the financial health and stability of an organization. And there are several different types of ratios, but for this lecture, we're going to be focusing on profitability ratios. So what does a profitability ratio tell you? It measures how efficient a company is with turning business activities into profit. And in this lecture, we're going to be going over the gross profit margin, net profit margin, and operating profit margin. All of the calculations to do this are derived from data on the income statement. And the gross profit margin indicates what a company is able to retain after it has deducted its cost of goods sold from revenue. Cost of goods sold are the expenses that are incurred to produce the product and or service. The net profit margin is what a company is able to keep after it's deducted all of the expenses from revenue. So your gross profit margin should always be more than your net profit margin. Why? Because for gross profit margin, the only thing that we're deducting from revenue are the cost of goods sold, whereas net profit margin, we are deducting all of the expenses. The operating profit margin tells how well a company is running its entire business from an operational standpoint, right? So this calculation is going to involve a term known as EBIT, earnings before interest and taxes. So on this screen, it provides you with all of the calculations to go through all of the profitability ratios that we're going to be covering. One thing that I want to point out is that sometimes companies will not indicate their gross profit margin on their income statement. They may only list revenue and cost of goods sold. If that is the case, then you need to calculate the gross profit. So here we are looking at Intel's income statement. And the first thing that we're going to look at is their gross profit margin. And the calculation is gross profit divided by revenue. So it's these two numbers here. So what is this telling me over the course of the 3 years? In 2020, the gross profit margin was 56, 2019 it was 59, and in 2018 it was 62. So what's happening? Is this getting better or worse? Well, the numbers are declining, which means that Intel is not able to keep that 62 cents for every dollar it earned back in 2018. It's now down to 56 cents of every dollar earned. So let's now look at the net profit margin. And the calculation is to take the net profit, the net income, and divide that by revenue. And when I do that, I get the following results. 2020, it was 27%, 29%, and 30%. And once again, we can see that the net profit margin is going down. So in 2020, Intel was able to keep 20 cents of every dollar it earned after all of the expenses have been paid. But in 2018, they were able to keep more. They were able to keep 30 cents for every dollar earned. And then there's the operating margin. Again, this information comes from the income statement, and it's the operating profit, EBIT, divided by revenue. So here's our operating income. And you can see that we're not using any of the taxes, excuse me, so it's earnings before income tax. So when I do the calculation, I see that the numbers are pretty steady, but they are getting worse, just as in all of the other profitability ratios that we've just calculated. So they're pretty steady, but it is declining year over year. So this is, something's going on with Intel, right? We look at their revenues. The revenues have been increasing, right? But their cost of sales, their cost of goods sold have gone up tremendously. And if I look at all other items, they're pretty much steady. So something's going on with Intel and how they are manufacturing their products. So here's what we've learned in this lecture. Profitability ratios, they measure how efficient a company is with turning its business activities into profit. Gross profit margin, the calculation, revenue minus cost of revenues, or gross profit divided by revenue. It tells how much a company is able to keep for every dollar earned once cost of goods sold is deducted from revenue. Your gross profit margin will always be higher than your net profit margin. With your net profit margin, you're taking net income, dividing that by revenue, and that tells you how much a company can keep for every dollar it has earned after all expenses have been deducted. Net profit margin should always be lower than the gross profit margin because it's taking into consideration all of the expenses. And the operating margin tells how well a company is running its entire business from an operational standpoint and does not include income taxes.